Today, we're setting our sights on a company that's been a fixture in the skies for decades, a familiar name to many budget-conscious travelers. But recently, it feels like its engines are sputtering, and the fasten seatbelt sign has been flashing not just intermittently, but almost continuously for quite some time. That's the rather turbulent ride we're taking you on today.
Indeed. We're talking about Spirit Aviation Holdings, Inc., known on the ticker as FLYY. This isn't some fly-by-night startup. Spirit was founded all the way back in 1964, headquartered in Dania Beach, Florida.
Wow, 64. Long history.
Yeah, a long time. Their core business model, as they've long championed, is to offer enhanced travel with flexible, affordable options, serving destinations throughout the United States, Latin America, and the Caribbean. They proudly operate what they call an all-Airbus fit fleet, which they consistently tout as one of the youngest and most fuel-efficient in the U.S., a key factor in their low-cost strategy.
Okay, let's truly unpack this. Our mission for this deep dive is to objectively and comprehensively analyze the financial health of FLYY. So let's start by checking the current temperature in the cockpit, specifically looking at Spirit stock price and recent market action. As of August 27th, the day our data was pulled, Spirit stock closed at a rather stark $1.38 per share.
Just $1.38.
Wow.
Yeah.
That represents a drop of 12 cents, or a significant 8.00%, just on that single trading day. It's not just a dip, it's a continuation of a very concerning trend.
It really is. And what immediately grabs an analyst's attention isn't just the price drop itself, but the sheer volume of trading activity surrounding it. The trading volume for that day was 930,169 shares.
Okay.
Which is remarkably high compared to its average daily volume of approximately 550,780 shares. A relative volume of 1.69 tells us that there was nearly 70% more activity than usual around that current price point.
So a lot of people were trading Spirit that day.
A lot. This isn't random fluctuation. It indicates significant market participation, very likely with a strong selling bias, as investors react to a flurry of recent news and revelations about the company's health. It suggests a strong conviction among traders that the stock's future is, bleak.
And when you look at the company's overall size, it's even more telling. Spirit has a market capitalization of just $35.71 million.
Tiny.
Yeah. Now, our Quiver source showed a slight discrepancy, listing it at $38.8 million. But either way, we're talking about a company that is, by any measure in the stock market, extremely small in terms of its equity value.
Here's where the financial alarms truly start to blare, and this is a key insight for anyone trying to understand Spirit's predicament. Compare that minuscule market capitalization of around $35 million to its enterprise value, which clocks in at a massive $6.31 billion.
Whoa. $6 billion versus $35 million.
Exactly. This isn't just a big difference. It's an enormous, almost unfathomable disparity. The market capitalization represents the value of the company's equity, right? What shareholders theoretically own.
The enterprise value, however, gives you the total value of the company, including its debt. This massive $6.27 billion gap between the two figures immediately signals that Spirit Aviation is carrying an absolutely gargantuan amount of debt on its books relative to its equity.
Okay, so that's the key takeaway there. The debt is overwhelming the equity value.
Overwhelming is putting it mildly. For a financial analyst, this isn't just a critical red flag. It's a blaring siren indicating profound systemic financial stress. It means that while the market values its ownership stake at tens of millions, the total value of the company, including what it owes to its creditors, is in the billions.
Right.
This fundamental imbalance acts like an anvil tied to its undercarriage, making any ascent incredibly difficult. Even if Spirit were to somehow turn a profit, most of that profit would likely be siphoned off just to service this massive debt load rather than building value for shareholders or reinvesting in the business. It's a crushing weight on any chance of recovery. That's quite the contrast in a very stark image. Let's turn now to the performance roller coaster Spirit has been on. And I say roller coaster, but for shareholders, it's been more of a precipitous descent off a very tall cliff. The performance metrics are truly dramatic, reflecting a sustained and catastrophic loss of investor confidence.
Yeah, roller coaster implies some ups as well as downs. This looks more like just down.
Pretty much. In just the last week, the stock dropped minus 7.38%. Over the last month, a staggering negative 68.85%.
Oof, minus 68% in a month.
For the quarter, it's down now to 77.45%. And year-to-date, Spirit Aviation has plummeted by negative 84.49%. These aren't just bad numbers. They represent an utter collapse of market value.
These figures are devastating. When you look at its 52-week range, the stock is currently trading at $1.38, which is an astounding 89.38% below its 52-week high of $13.
Down almost 90% from its peak. So basically hitting rock bottom.
Pretty much. This isn't just a dip in the market, it's a full-blown financial freefall, suggesting deep-seated systemic issues that the market views as potentially insurmountable. For investors, this signals a complete lack of faith in the company's ability to recover.
And the moving averages don't offer any comfort either, do they? The stock is trading significantly below its short, medium, and long-term average prices, negative 45.86% below its 20-day simple moving average, or SMA.
The short-term trend line.
Right. It's negative 65.13% below its 50-day SMA and negative 71.48% below its 200-day SMA. These are technical indicators that reinforce the grim fundamental picture.
Absolutely. These moving averages are often used by traders and investors to gauge trend strength. When a stock is trading so dramatically below all these key averages, short-term, medium-term, and long-term, it simply confirms what the raw performance numbers suggest, a very strong, entrenched, bearish trend.
No signs of a turnaround there.
No, there's no indication of any short-term or even long-term recovery in the stock price trajectory based on these technical indicators. The market sentiment is overwhelmingly negative, reflecting the deep-seated issues at play, and it suggests that any upward movement would likely be met with selling pressure, as investors use any small bounce as an opportunity to, get out.
Speaking of negative, let's look at the red flag headlines.
Yeah.
Because there's been a veritable cascade of concerning news for Spirit Aviation, and the most ominous, in my opinion, came on August 12, 2025, when Spirit Airlines issued a going concern warning.
That's the big one.
Yeah. This isn't just a minor blip on the radar. It means the company explicitly stated in its financial disclosures that there's substantial doubt about its ability to survive the next year without securing more cash or taking drastic action.
That phrase, going concern warning, is about as severe as it gets in corporate finance. It's a statement by management, often compelled by their auditors, that the company's very existence beyond the next 12 months is uncertain unless significant corrective actions are taken.
So basically they're saying, we might not make it.
Essentially, yes. This isn't just about bad profits. It's a warning of existential threats, putting everyone, investors, employees, suppliers, and even customers on high alert. The widespread coverage this received across multiple financial news outlets like The Wall Street Journal, Fast Company, Investors Business Daily, and the Associated Press really underscores the gravity of this situation. It signals that if new funding isn't secured or a major turnaround isn't achieved, bankruptcy is a very real possibility.
And the financial market's reaction, as expected, was swift and brutal. Just a few days later, on August 15th and again on August 22nd, both Fitch and Moody's, two of the major global credit rating agencies, cut Spirit's credit rating even further into what's termed junk territory.
Right, deeper into junk. This has profound implications for a company already teetering on the edge. Credit downgrades mean that any new borrowing Spirit attempts to undertake will come at a significantly higher interest rate,
making it more expensive to borrow money they desperately need.
Exactly. Incredibly difficult and expensive for them to access new capital when they desperately need it. It sends a clear and unambiguous signal to potential lenders and investors that the company is a much higher risk, effectively tightening the noose on their ability to secure financing for operations or desperately needed restructuring. It also impacts their relationships with lessors for their aircraft, fuel suppliers, and other critical partners who may demand more stringent terms or even prepayment, further squeezing cash flow.
Adding to the turmoil, on August 22nd, news broke that Spirit had engaged advisors to explore repeat restructuring after previous revamp efforts had already faltered. The term repeat restructuring itself suggests a deeper, more persistent problem.
Precisely. The emphasis here on repeat restructuring isn't just a matter of semantics. It strongly suggests that this isn't a one-off attempt to fix temporary issues. It points to ongoing, systemic problems within the company's fundamental business model or its cost structure that haven't been resolved by prior efforts.
So whatever they tried before didn't work.
Didn't stick, basically. It hints that the problems are deeper than temporary setbacks and are proving very difficult, perhaps even intractable to overcome. It tells us that past solutions didn't stick and they're back at square one, but with even less time and fewer resources.
And the urgency was further confirmed on August 25th with widespread reports that the company was scrambling for a lifeline following a significant cash crunch.
That cash crunch directly ties into the going concern, warning, and credit downgrades. It means Spirit is rapidly running out of readily available funds to meet its short-term obligations like payroll, fuel purchases, payments to suppliers.
Basic operational costs.
Exactly. The search for a lifeline implies they are looking for emergency capital, potentially a new loan, a debt-for-equity swap, or even an outright sale of assets, all aimed at staving off immediate insolvency. This isn't about long-term strategy anymore. It's about day-to-day survival.
We also saw news on July 28th that Spirit Airlines announced plans to furlough and demote pilots, which Barron's.com reported caused the stock to fall further. This isn't just a line item, it's a human impact.
Absolutely. Furloughs and demotions are classic, painful, cost-cutting measures, usually enacted when a company is under severe financial strain. It indicates that Spirit is desperately trying to reduce its operational expenses, particularly labor costs, which are a huge component for any airline.
Right.
Beyond the immediate financial impact, this has significant ramifications for employee morale, potential service quality, and sends yet another undeniably negative signal to the market about the company's health. It can lead to an exodus of experienced talent and make it harder to attract new pilots when demand eventually rebounds. It's a move of desperation, not strategic growth.
Even earlier, back on May 27th, Spirit received a NYSE American delinquency notification. While it might sound technical, it's another indicator of deeper trouble.
Absolutely. This is a procedural warning from the stock exchange indicating that Spirit had failed to meet certain listing standards, possibly related to minimum share price, market capitalization, or reporting deadlines.
Just basic compliance stuff.
Right. Well, it might seem like a mere administrative hurdle. It's yet another symptom of deeper financial issues and operational instability that are causing the company to fall short of regulatory requirements. It signals to the market that the company isn't even meeting basic compliance metrics, which further erodes confidence.
What I find truly fascinating and almost contradictory are the company's simultaneous efforts. Amidst all these dire warnings and financial red flags, the going concern, the credit downgrades, the cash crunch, the pilot furloughs, we also see Spirit pushing out positive PR.
Yeah, that's the strange part, isn't it?
They're announcing new routes to places like Savannah, Grand Cayman, Belize, and Key West. They're talking about refreshed in-flight menus, loyalty program enhancements, anniversary deals, and sweepstakes. It's like they're trying to project an image of vibrant growth while the foundations are cracking.
This creates a really compelling, almost paradoxical tension, doesn't it? On one hand, you have the severe financial reality, the clear and present existential threat. On the other, the company is actively trying to project an image of growth, innovation, and business as usual.
Trying to put on a brave face.
Exactly. But the insight here is that this isn't just compelling. It reveals Spirit's almost impossible balancing act. They're forced into what you could call a growth-at-all-costs strategy, even as their very existence is in question. In a low-cost, high-competition industry, companies often find themselves trapped in a damned-if-you-do, damned-if-you-don't dilemma. Cut costs too aggressively, and you risk alienating customers and losing market share to competitors like Frontier. But expand too much without the necessary cash flow, and you simply dig a deeper hole.
So these announcements might just be making things worse.
It's a huge risk. Spirit's announcements aren't just PR. They're a desperate roll of the dice, a gamble that future revenue from these expansions will materialize before their current cash runs dry. It's a high-stakes bet that could either be their salvation or accelerate their demise.
Okay, so let's truly dive into these raw numbers and dissect why the alarm bells aren't just ringing, but screaming.
Yeah, let's get into the nitty-gritty.
We'll start with their profitability, or rather, their profound lack of it, which is a sea of red.
Absolutely. When you look at Spirit's income, it's a massive negative $1.078 billion.
Over $1 billion in losses.
Yeah. That isn't just a loss, it's a financial hemorrhage for a company of its size, and it's undeniably a key driver behind that going concern warning we just discussed. They are losing an extraordinary amount of money, and what's particularly alarming is how this cascades through every measure of profit. For instance, their earnings per share, or EPS, for the trailing 12 months is a deeply negative $12.90.
Negative $12 per share.
Right. This isn't just a bad period. It indicates a fundamental, worsening inability to generate any real profit from their operations. It's like their business model is actively consuming shareholder value.
And it's not just negative. It's getting significantly worse.
Mm-hmm.
Their EPS year over year for the trailing 12 months is down medical 108.45%. And quarter over quarter, it plummeted by negative 310.9%. -0.73%.
Whoa, minus 310% Q over Q.
Yeah, even looking back, EPS over the past 3 to 5 years is down a substantial -35.63%. This isn't a slow leak, it's a gushing wound.
Exactly. These figures paint a very clear picture of a complete lack of profitability and, crucially, an accelerating decline in earnings.
Yeah.
It's not just that they're not making money, their losses are consistently deepening.
Not moving in the right direction at all.
Not remotely. This isn't a story of slow growth or stagnant earnings. It's a story of significant and worsening losses per share, indicating that the business model as currently executed is simply not generating sufficient revenue to cover its costs. And this unprofitability extends to all their margins too.
Okay, let's look at those.
Their gross margin is a razor-thin 1.45%.
1.5%, barely anything.
Basically nothing, meaning after just the direct costs of providing their service, think fuel, direct labor, aircraft maintenance, nearance, they barely have anything left. Their operating margin is a deeply negative 20.83%, and profit margin is an even worse negative 24.52%.
So they're losing money on operations and overall.
Significantly. These indicate a fundamental issue with their business model's ability to generate cash from operations, especially in a competitive, low-cost airline market where every penny counts. They're struggling profoundly to cover even their most basic costs, let alone turn a profit on their revenue.
And if you track that through to the return on assets, equity, and invested capital, it's all deeply negative, which is quite alarming. Return on assets is negative 11.89%. Return on equity is a shocking negative 167.32%.
Minus 167% ROE, that's just staggering.
And return on invested capital is negative 15.52%.
For a listener who understands what return on equity, or ROE, signifies how much profit a company generates for each dollar of shareholder equity, a figure like negative 167.32% screams value destruction on a grand scale.
It means they're burning through shareholder money.
At an incredible rate, yes. It means the company is not only failing to generate returns for its shareholders from the assets it owns, but it's actively consuming and diminishing that shareholder equity. It implies they are losing far more than their equity base, rapidly eroding the value of the ownership stake for investors. This isn't just underperformance, it's a company rapidly eating into its capital, making investment a highly dangerous proposition.
Moving on to revenue trends, the picture is a bit mixed, but ultimately still concerning. Spirit reports total sales of $4.4 billion, which seems like a substantial number.
$4.4 billion in sales sounds good, right? But
the price to sales, or PS ratio, is an incredibly low 0.01.
0.01. Now, in some contexts, the very low PS ratio might sometimes suggest an undervalued company, where the market hasn't fully appreciated its sales potential.
But given everything else.
Exactly. However, when you combine this with Spirit's deeply negative profitability figures, the massive debt load, and the ongoing cash crunch, it more likely reflects extreme market skepticism. The market is essentially valuing Spirit sales at almost nothing, indicating a profound lack of confidence in the company's ability to translate those sales into sustainable profit or even to survive long term.
So the market just doesn't believe in those sales, essentially.
Or doesn't believe they'll ever translate to the bottom line, yeah. It suggests investors believe those revenues are either not sustainable or the company is so burdened by costs and debt that sales growth won't translate to shareholder value.
And recent sales figures show a clear decline, which directly impacts their ability to generate cash flow. Sales year over year for the trailing 12 months are down negative 14.19%, and quarter over quarter they fell by negative 20.38%.
These recent sales declines are crucial. They suggest a shrinking business or significant demand issues, which directly impacts the company's ability to generate the necessary cash flow to stay afloat.
Hard to fix things when less money is coming in the door.
Incredibly tough to stem a financial crisis when your top-line revenue is contracting so significantly, especially for a low-cost carrier whose entire model relies on maximizing volume and efficiency.
But then, interestingly, we see reported historical sales growth over the past 3 and 5 years of 15.00% and 5.11% respectively. This seems to contradict the recent declines.
Yeah, that's a bit of a head-scratcher too. This highlights an apparent and quite jarring contradiction, doesn't it? While historically Spirit did show some sales growth, indicating perhaps successful expansion or market penetration in the past.
They were growing before.
Right. But the recent year-over-year and quarter-over-quarter declines indicate a sharp and very recent reversal of fortunes. It suggests that whatever growth strategies were in place are no longer effective, or that external pressures like intense competition, economic headwinds, or even the perception of their financial instability have become so overwhelming that they've completely wiped out any previous momentum.
So past success doesn't mean much now?
Not in this context, no. The past performance, in this case, doesn't necessarily predict or even correlate with the current struggle. It simply underscores how quickly things can change in this industry.
Now, for financial health and solvency, it looks like Spirit is operating on very shaky ground. Their liquidity ratios, like the quick ratio and current ratio, are both 1.02.
Just barely above 1.
And it shows cash per share at $21.62. These figures sound okay on the surface, just above 1, but what do they really mean in this context?
You're right to question that. While these ratios are technically just above 1, indicating that current assets barely cover current liabilities, this level is often considered precarious, particularly for an airline.
Which needs a lot of cash on hand.
Exactly. They require significant capital, have high fixed costs, and face variable operating expenses like fuel. It suggests very little cushion for unexpected expenses or operational disruptions, directly reinforcing the cash crunch narrative we heard in the news. It means they're essentially running day to day with almost no buffer.
And that cash per share figure.
The high cash per share might seem positive in isolation, but it must be viewed in the context of the massive debt burden and ongoing losses we just discussed. That cash could be quickly eroded by debt service, operational losses, or unexpected maintenance issues. It's a fleeting asset against a mountain of liabilities.
And speaking of debt, the debt-to-equity ratio is a staggering 14.25, with long-term debt to equity at 13.50. This is an absolutely enormous number.
An absolutely enormous number is an understatement. A debt-to-equity ratio of 14.25 is extremely high. It's a flashing neon sign of severe over-leverage.
14 times more debt than equity.
Basically, yes. To put it simply, it means the company relies almost entirely on debt financing compared to shareholder equity. For every dollar of shareholder equity, Spirit has nearly $15 of debt. This enormous debt burden contributes significantly to that massive enterprise value we discussed earlier and places immense pressure on the company's ability to service its debts.
Which must be incredibly difficult with falling revenue and losses.
Potentially insurmountable. With declining profitability, the cost of servicing this debt becomes an even greater challenge. It severely limits Spirit's strategic flexibility, their ability to invest in their fleet, compete on price, or weather any further industry downturns. This is unequivocally a massive red flag for solvency and long-term financial viability. It means they're constantly fighting against a massive financial undertow.
Finally, let's look at the book value per share versus the current share price. The company's book value is $18.52 per share, while the current price is a mere $1.38. That's a huge disparity.
It really is. The fact that the company's book value per share is so significantly higher than its current share price is a classic indicator of deep market distress and profound cynicism. Book value essentially represents the theoretical value of a company's assets if it were to be liquidated.
What the assets are worth on paper.
Right. This massive gap often happens when the market believes that the company's assets, as recorded on its books, are either grossly overvalued or, more commonly, that the company will simply not be able to realize their stated value due to ongoing losses, operational issues, and overwhelming debt obligations.
So the market thinks the assets aren't really worth that $18.52, or they won't get it.
Exactly. It's a clear sign of extreme skepticism about the company's future and its ability to turn things around, suggesting investors believe the assets won't be worth what they're currently listed at when the dust settles, or that the debt holders will take priority over shareholders in any kind of liquidation or restructuring scenario.
Let's shift our focus now to who actually owns Spirit Aviation and what that tells us about broader market sentiment. First, the breakdown of institutional versus insider ownership. A staggering 96.59% of Spirit shares are held by institutions.
Almost all of it.
While only a small slice, 3.41%, are held by insiders.
This very high percentage of institutional ownership, nearly all of it, means that the vast majority of FLYY's shares are in the hands of large investment funds, pension funds, and other professional money managers. While this can sometimes mean higher liquidity in a declining stock.
It can make things worse if they all sell.
Exactly. It also means these large holders can trigger significant price movements if they decide to liquidate their positions en masse, further exacerbating the stock's decline. Think of it like a stampede. When the big players decide to run, there's little stopping them.
And what about the low insider ownership?
The relatively low insider ownership, coupled with the fact that our sources state insider transactions, 0.00%, and explicitly no recent insider trading, is also quite telling. High insider ownership often signals management's confidence in the company's future because they have their own skin in the game.
Right, they believe in it enough to own it.
Yes. The low percentage and the complete absence of recent insider buying could suggest that those closest to the company, the executives and directors, are either not buying shares or they simply don't own a significant portion to begin with. This certainly doesn't inspire confidence when the company is in such a precarious position. It might even be interpreted as a lack of conviction from those who know the company best.
Moving on to short interest, we find that a significant portion of the market is actively betting against Spirit. The short float is 9.85%.
Almost 10%. It's notable.
Representing 2.46 million shares held short. The short ratio, or days to cover, is 4.47. What does that signify for the stock's immediate future?
A short float of nearly 10% is moderately high and indicates that a substantial number of investors are actively taking positions that profit if the stock price goes down. These short sellers are often sophisticated investors who have done their homework and are essentially saying, we believe this company is headed for trouble.
So they're betting on failure.
Pretty much. The short ratio of 4.47 means it would take nearly 4.5 trading days for all short sellers to cover their positions, assuming average trading volume. This suggests there's still considerable conviction in the bear case, meaning those betting against Spirit believe there's more downside to come.
Adds downward pressure.
Definitely. This high short interest adds to the downward pressure on the stock and further reflects the overwhelmingly negative market sentiment. It's a very tangible vote of no confidence from a significant segment of the market. While a very high short interest can sometimes lead to a short squeeze if unexpected positive news emerges.
A quick pop in price.
Right, but the fundamental situation here makes that scenario far less likely to be sustained.
And when we look at volatility and investor psychology, the numbers are exactly what you'd expect for a company in this much distress. We see volatility at 13.87% for the week and 14.28% for the month.
Very jumpy.
The average true range, ATR, over 14 periods, which measures average daily price movement, is 0.31. Most strikingly, the relative strength index, RSI, over 14 periods is a deeply low 16.89.
The high volatility numbers are entirely predictable given the torrent of negative news flow and the dramatic, often daily, swings in the stock price. The ATR of 0.31 suggests that the average daily price movement in dollars is quite significant, especially relative to the stock's current price of $1.38, indicating a wild, unpredictable ride for shareholders.
And that RSI, 16.89, that's really low.
Extremely low. Now, an RSI of 16.89 is deeply in what's typically considered oversold territory. For a healthy stock, this might technically suggest it's been sold off too heavily and could be due for a bounce.
But maybe not here.
Probably not sustainable here, no. It's crucial to remember that deeply troubled stocks often remain in oversold territory for extended periods because the fundamental problems persist and there's no clear catalyst for a sustainable recovery. It reflects extreme pessimism, not necessarily an imminent rebound. It's more a sign that almost everyone who wanted to sell has already sold, but there are few buyers willing to step in.
Now, let's explore the operational realities for Spirit, particularly how it's attempting to compete, expand, and enhance its services, all under this immense financial pressure. First, let's look at the competitive landscape, which is arguably more aggressive than ever for low-cost carriers.
Especially with Frontier breathing down their neck.
Exactly. Multiple news articles from August 27, 2025 highlight Frontier Airlines actively eyeing growth in top U.S. markets, moving in on Spirit's turf with 20 new routes, and quite directly, challenging rival Spirit with new routes.
This is a critical external factor that intensifies Spirit's internal struggles. Spirit is not only battling its own severe financial demons, but is also facing intense, aggressive external pressure from a direct competitor that operates on a very similar low-cost model.
They're going head-to-head.
Absolutely. Frontier's strategic moves, like unveiling a $69 Elite Gold status offer to lure rival flyers on August 19th, are explicit, targeted attempts to poach Spirit's customer base and seize market share. This significantly intensifies Spirit's struggle for revenue in an already difficult environment.
It's like getting kicked when you're down.
It really is. It's like trying to bail out a sinking ship while a rival vessel is actively ramming into your side and trying to steal your life rafts. This relentless competition makes Spirit's already precarious financial situation even more challenging, as any slight misstep can result in an immediate loss of customers to a hungry rival.
What I find truly fascinating and somewhat perplexing from a strategic standpoint are the seemingly contradictory strategies Spirit is employing, trying to expand and enhance its operations amidst this profound crisis.
Yeah, the new routes announcements seem bold, given the circumstances.
Despite the severe financial warnings, Spirit continued to announce new service and increase connectivity in various locations, including Savannah, Grand Cayman, Belize City, Key West, Macon, Columbia, and Chattanooga, with announcements stretching from August all the way back to June 2025. It feels like they're trying to grow their way out of a hole.
This presents a remarkable and deeply risky contrast, doesn't it? On one hand, the company is issuing going concern warnings and engaging advisors for restructuring because it might not survive the year. On the other, it's strategically trying to grow its network and launch new routes.
So what's the thinking there? Is it desperation?
It could be interpreted in a few ways, none of which are without significant risk. Perhaps it's a desperate, almost last-ditch attempt to generate new revenue streams and maintain market presence, hoping that an influx of future revenue will materialize before their current cash runs dry. Or it could be a long-term strategy that they're determined to execute despite the short-term pain, clinging to the hope of an eventual turnaround. However, it definitely raises a critical question. Are these expansions financially viable given the current cash crunch, the deeply negative profitability, and the severe operational losses?
Right. Does launching new routes actually cost more money right now?
It absolutely does. Launching new routes requires capital, marketing, and operational resources, all of which seem to be in critically short supply. It's a high-stakes gamble that could either be their salvation or, more likely, simply accelerate their demise by expanding their liabilities without guaranteeing commensurate revenue.
And it's not just routes. Spirit has also been focused on guest experience enhancements. In May 2025, they rolled out a refreshed in-flight menu, new extra legroom seating options, and a revamped free Spirit loyalty program. Again, these sound like things a healthy, growing company would do, not one facing an existential threat.
These initiatives are clearly designed to improve customer satisfaction and retention, which is vital in any competitive industry. They're trying to protect their core business and reputation.
Keep the current customers happy.
Right. However, implementing such changes, especially new seating options and refreshed menus, requires significant capital investment and ongoing resources. This again seems to contradict the narrative of a company facing a severe cash shortage.
Spending money they might not have.
It's a gamble. A gamble that these enhancements will attract enough new customers or retain existing ones to outweigh the financial distress and generate sufficient revenue to justify the investment. It's a strategic choice that adds another layer of complexity to their precarious situation, forcing us to question their priorities. Are they spending precious, dwindling capital on long-term improvements when the short-term survival is the most immediate crisis? It's a very difficult tightrope walk.
And they're still running promotional activities like 4th of July deals and their 33rd anniversary flight giveaway. It's almost business as usual in some respects, which, in the face of these headlines, is quite disorienting.
It is indeed. These are typical marketing efforts designed to attract and retain customers, generate buzz, and fill seats. But in the context of a going concern warning, credit downgrades, and pilot furloughs, they highlight the company's incredibly precarious position.
Gotta keep the planes flying, I guess.
They still need to attract customers and fill seats to generate any revenue whatsoever, while simultaneously grappling with an existential threat. It's a sign of a company trying to maintain a facade of normalcy and keep the revenue spigot flowing, however weakly, while fighting for its life behind the scenes. It's a delicate dance of projecting confidence while internal alarms are blaring.
Finally, let's touch on the workforce impact, which is a very tangible consequence of this financial strain. We saw the news from late July 2025 about furloughing and demoting pilots. FinViz listed 11,941 employees, while Quiver showed 11,331. These furloughs would undoubtedly affect those numbers and morale.
This is a direct, tangible indicator of severe cost-cutting and a response to operational constraints, likely due to reduced flight schedules or a need to right-size the workforce. Furloughs and demotions are usually a last resort for companies trying to reduce expenses.
A painful move.
Very painful, yes. In response to declining demand or severe financial constraints, it's a painful but often necessary measure during a crisis. Beyond the immediate cost savings, it has significant long-term ramifications. It can deeply impact employee morale, lead to a brain drain as experienced pilots seek more stable employment.
You lose good people.
Exactly. And make it far more challenging to recruit and retain talent when and if the company needs to rebuild its operational capacity. It also impacts relations with unions and can potentially affect the quality of service if it leads to staffing shortages or a less experienced workforce. It's a very clear, unfortunate sign of the company tightening its belt under duress, and it speaks volumes about the depth of their financial woes.
So we've taken a pretty deep dive into the numbers in the news. But as with any comprehensive analysis, especially in a rapidly evolving situation, there are always some unanswered questions, some gaps in the data that, if we had them, would provide an even fuller picture.
Always more you want to know.
For instance, our sources did not provide any analyst ratings, price targets, or forecasts for FLYY, nor any bull case versus bear case summaries.
This is a significant omission, particularly for a company in such a volatile state. Without analyst outlooks, we lack a professional market consensus on what the future holds for Spirit. Are there any optimists left?
Are any analysts saying, buy? Probably not many.
It seems unlikely, but it would be incredibly valuable to know if industry analysts see any viable path to recovery or if the professional sentiment is uniformly negative, indicating that the smart money has truly given up. This leaves a significant gap in understanding future expectations beyond just the raw numbers we've discussed, making it harder for listeners to gauge the broader investment community's perception.